this year is going to be 77th year of India's independence. I think the premise was that by 2030, our GDP will double, and it actually opens up a lot, especially for financial services. Because if you look at money, money touches our lives every day, like literally, like multiple times in a day. We save money, we spend money, we kind of insure ourselves. We grow our money in various formats, and so on and so forth. Right? There's so much we do with the money, and as typically GDP grows, this is one of the sectors which is, it's actually the largest industry in the world. It's a $15 trillion industry, financial services. And in that, fintech is slowly and gradually, taking up market share. So it is pretty natural that India will see probably like 20, 30, 40 very large companies, over the next 10 years.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Amit Goel with us. Amit is the founder of 77 Capital, an early stage fund investing in fintech and other startups. He was earlier the country head India and vice president at Proof. He was the founder of Medici that was acquired by Proof. He is consistently rated as both global and Asia's top 100 experts in fintech by various agencies. In this episode, we talk about Amit's story and how he started investing. How do they map out the fintech landscape? What are the saturated and unsaturated segments in the Indian fintech space? SME IPOs and how it's a great option for B2B startups to explore. How hard it is to sell to banks. Mistakes that fintech founders should avoid, and so much more. So, without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So, if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So, if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey Amit, so good to have you on the VC10X podcast. How you doing?
I'm doing great, Prashant. Thank you so much for inviting me to the podcast.
Yeah, it's a pleasure having you on. Can we start with your story and how you started investing?
Absolutely. Yeah, so my story is like this. I basically built analytics advisory firm, and then in 2012-13 figured out that financial services going to get disrupted by the technological advancements which are happening, and met a lot of fintech founders, very like the first lot of fintech founders in the US and in Asia. And I met my co-founder in the US. He was based out of US. He had built the NFC payment systems in the US, and we decided that we have to do something in the space. Initially, we were looking at a fintech application, but then we decided that we should actually build something on the lines of Bloomberg for fintech space. So we started building this company called Medici. It was a US headquartered company. It very popularly came to be known as the Bloomberg for fintech space because we were tracking 17,000 fintech startups. Um, and we had a few other things going on because it reflected very much like how Bloomberg is organized. And we had subsidiaries in India, Singapore, and Europe. And basically, we had hired engineers in Bangalore, and we built a platform which could track any startup in the fintech space, collect business and financial information on it. And we created like this whole enterprise subscription for banks, financial institutions, and investors. And we basically hit about $2 million plus in ARR. We were used by regulators like MAS and governments, as well as all lot of large banks and financial institutions like DBS Bank in Singapore, Bank of America, what have you, like even in India, Yes Bank, HDFC, and so on and so forth. I actually sold that company in 2021 to Prove. Prove is a multi-billion dollar identity and authentication company in the financial services space. And there I get to work in a big tech company. I basically was their country head for India. And I was able to get this opportunity to build a business from scratch again. And so it was very entrepreneurial, and I basically built the team and launched the product in the Indian market, a good pipeline over 2.5 years. And then finally I decided that it's probably time to move on and do something new. Um, a parallel story which is happening, throughout this thing is that because Medici was in the business of tracking fintech companies, um, I met a lot of investors who were using Medici platform, and they kept telling me like the killer application of a platform like this, where you are tracking all the fintech companies, is investments. And I was meeting all these wonderful people, who were creating new companies, and we had a lot of understanding from global markets as well, right? So I decided that I should take a plunge and start investing in my personal capacity. So I became an angel investor. This was, I would say, 2018-19 timeframe. And then from there on, created multiple vehicles, including an investment holding company, in Singapore, as well as syndicates in US and in India. And we started investing quite a bit after I sold the company in 21. And there are a bunch of people who wanted to join me in investing in these companies, so the group kept getting larger and larger. um, so yeah, that's how I got into investments. And I was very fortunate, I would say, that the type of company I was building naturally led me into investments, because our core business was actually looking at which companies are growing faster, what banks are looking for, where are the gaps, uh, what business models actually survive and thrive, right? I'll give you a classic example, and then I'll stop. Basically, we used to work for this company called Marketa, was one of our customers, and they basically were a card issuing platform in the US. So I saw the power of financial infrastructure play. And when Madhu, who is a ex Visa guy, started M2P, it was a very natural sort of decision for me to invest in the company. And they have done really well. They're a pretty large company now. So yeah, long story short, I got into investing because it's a at some level it's a knowledge, data, and insights play. And we were in the thick of things in fintech and financial services.
Absolutely, that's a very incredible story and sort of a natural progression from building your startup, exiting it, and since that startup was about tracking all these fintech startups, you started and now you've formalized it into 77 Capital, which is now a VC firm that's investing into fintech startups mostly, I believe, right? So can you tell us more about what's the focus at 77 Capital?
Yeah. So seven is a lucky number. Seven is MS Dhoni, jersey number seven, Ronaldo number seven. But the most
Yeah.
important thing, which is why we believe, what we are doing and what we are investing in, is that this year is going to be 77th year of India's independence. And I think the premise was that by 2030, our GDP will double. And it actually opens up a lot, especially for financial services, because if you look at money, money touches our lives every day, like literally, like multiple times in a day. We save money, we spend money, we kind of insure ourselves. We grow our money in various formats, and so on and so forth, right? There's so much we do with the money. And as typically GDP grows, this is one of the sectors which is, it's actually the largest industry in the world. It's a $15 trillion industry, financial services, and in that fintech is slowly and gradually taking up market share. So it is pretty natural that India will see probably like 20, 30, 40 very large companies in the over the next 10 years, and basically going after that. The other um, theme that we picked up is that and we are not fintech. Just one of the other points I wanted to touch upon, we we're not just doing fintech investments, we also do B2B software, Gen AI startups and few other things, but it's all connected. The other theme we have is we feel that not only because of the success of Zoho and Freshdesk, but also somewhere with the success of M2P and Perfios in international markets, I think what is happening in India today is so many people are starting entrepreneurship and they are starting companies, and we are just so good at software and solving problems with software that India will actually become a software factory for the world. So this is like I call it Infosys 2.0, 3.0, whatever point 0 you want to call it, but essentially I have been meeting a lot of founders who are doing between $7 to $50 million ARR in the US market. A lot of them are not even based in the US market; they're based here in India, and none of their sales guys is in the US. So today, I can say very confidently that it is possible to build a global B2B fintech software company or a B2B software company from India and then sell globally. It's an incredible opportunity. So we are also looking at that. um, the other thing is that we just realized that with Gen AI, once we started working in that space, also playing around with the technology, to be honest, a little bit, we realized that a lot of things which were built in the past under the SaaS umbrella are now all up for disruption. Like everything which has been built in a typical software way with a SaaS business model can be reinvented and rewritten with LLMs and Gen AI, and it's an incredible opportunity. Even at SaaS Bhumi, I think one of the largest SaaS events, this was discussed, and I'm just seeing it at work. We have seen a few of the applications, and so that is also a very very interesting opportunity. Largely, if I was to summarize, we invest in core fintech, which is your typical payments, lending, etc., etc. We invest in X for financial services, which means you know fraud, security, cloud, Gen AI, any of the tools or things for financial services, or even for other sectors, but the majority should be financial services. And then the third is the intersection of financial services with other industries. For example, agriculture and financial services, healthcare and financial services, and so on and so forth. But I have to confess that slowly and gradually, I think our remit is also expanding, and we are looking at non-financial services, B2B software as well, quite a bit now.
Absolutely, that's very interesting. And you briefly mentioned about how Indian founders are also now targeting global markets, right, and being successful at it. So, do you think new founders who are starting out should have global markets on their radar right from the front, or should they be going after the Indian market first and then looking to expand? Because I heard a successful founder who has built a sizable company now in the US, more than a unicorn now, talk about that if you want to build a good sizable company, you have to look out and you have to build it for the world, right? He was an Indian founder. So do you believe that is right?
Yeah, it's a very nuanced question, Prashant. So, one we have one rule at 77 Capital, that there are no rules. Okay, basically, there is no pattern, there is no set criteria of success, and there's no one way of doing things. Like YC advice, Y Combinator advice was very relevant till 2022, and I think we saw it falling apart in 23 and 24 as the tech market started melting down. In fact, Sam Altman himself said that a lot of things we used to teach at YC may not be true in all the cases. So one thing I've realized is what applies to one type of startups does not apply to the other type of startups. But the problem is media and a lot of what we see in the market and on Twitter basically makes it sound like everything is the same, and that's where a lot of young entrepreneurs and founders get very confused, right? So to answer your question, I would give you like three examples, right? So that you can then pick it up, right, in terms of what works or what doesn't. Let's say if you're building a lending fintech company in India, right? So you're working with an NBFC, and you are basically onboarding customers and you're providing them BNPL or unsecured loans in a very nice digital app, and the experience is what you're focusing on. The capital comes from the NBFC. You are in the thick of things, right? You have to understand regulations, compliance, cost of capital, net interest margins. That kind of a startup, it's very hard to transport internationally, because in every other place the lenders and this lending stack and regulations and compliance changes. Now let's take a different example, right? One of my portfolio companies is basically providing connectors to accounting systems in the world and ERPs in the world. So you have a Tally in India, or you have a Zero in Singapore, or you have a local Saudi accounting system, or a NetSuite in the US, what have you, right? They can actually connect and pull the data for the businesses or SMEs that you're looking at, either as a spend management, expense management company, or a lender. Now, that is the kind of startup that is very fungible across markets. So it makes a lot of sense. You get a few customers, make some mistakes in the Indian market. Indian market mistakes are cheaper, and build it at low cost. And then you start supplying it outside, where typically the billing rates will be, let's say, if here you are charging like 50 cents per account per month, you may get up to $5 per account per month, right? As an example. Um, there's a third type of companies as well, which are actually built for the world right from the beginning, right? For example, um, within 77 Capital, we are not just looking at investing in companies, but we are also looking at building a couple of them, right? Like a company builder, right? So, as I said, right, we don't have any rules. Like we do what we feel is, with first principles, is the right decision to do, right? So one of the things that we are building is, using Gen AI, we are building a personal productivity enhancement, productivity app basically. And that kind of a product is meant for markets where time is of much bigger value than, let's say, any other thing, right? Time is very, very, like, sort of critical and important. So we feel it is a very global product from day one, and we have to sell it in markets like US, and Singapore, and so on and so forth. So these are the three type of examples. I would say every situation is different.
Absolutely, that's a beautiful answer covering all the different aspects of it, right? And let's also talk about what are the different subcategories that you've mapped out within fintech and the different kinds of solutions that are there.
Right. So financial services fintech is a very, very broad segment. During Medici itself, we had done a very vast segmentation, which had about 100 different segments and subsegments. Um, I would not go into each one of them, but broadly, look, there is one thing which is, where do you save your money, right? Typically in your bank account. Then there are public sector banks, private sector banks, but there are neo banks as well. So that is like one segment. Then there's payments. Payments is of different types, right? We do UPI payments. There are government payments, bill payments, and so on and so forth. And then there are similarly B2B payments, when you pay businesses. Within that, there is domestic payments and there is international payments. So there are a lot of remittance companies, consumer and B2B remittance companies. Then when you come to lending, what we when as individuals we take loans, that is the whole consumer loans, and it's a very big area. There's a lot of unsecured lending companies, and a few secured lending companies as well, right? Like loan against gold. And then similarly on the businesses side, there is a lot of secured and unsecured loans, which are there. Then there's the wealth segment, in which wealth and investment. So one is, where you are managing a certain AUM of a person, and then you are basically investing into different asset classes. But then there is also very specific, like, for example, Zerodha or Grow or Paytm Money. You started using them for stocks, but then they expanded into mutual funds and what have you, right? So there's that whole wealth space, which is very, very big. um, of course, my favorite is the B2B fintech, which is software which is sold to banks and financial services, and software which powers the financial infrastructure. And there are lots of companies in that space. M2P, SignZ, these are companies which do eKYC, digital onboarding, LOS, LMS. Perfios is there, which recently became a billion-dollar company. There's Decentro, there is FinSire. There are so many companies in that area, which basically is one of our biggest focus, so to say. Apart from that, there's insurtech. A lot of interesting things are happening in that, and so on and so forth. So there are like literally there are like 100 segments and sub-segments within financial services. Will take us like couple of hours to go through all of them.
Right, right. Absolutely. I think that's a good brief answer there to give our listeners a good overview. And you talked about these different segments broadly, and which segment do you think is still underserved, and which segment do you think is overserved, especially in the Indian market?
Yeah, I think so. Overserved in terms of number of companies in the market, maybe a good
Right.
criteria. Uh,
Yeah.
there could be other criterias as well. So I'll just keep it single dimensional here.
Sure.
So I feel that there are a lot of companies who claim that we know where to invest, and so we can do some sort of algorithms and all that for your wealth management. I think there's a lot of companies in that area, and unfortunately, wealth management is a AUM game, right? So Morningstar had said in the US when Wealthfront and a couple of these companies were coming up that unless you hit like 15-20 billion dollars in AUM, you won't even break even. I think there would be some sort of an equivalent number in India as well. I think it's a hard business. Unless you hit those AUMs, it remains a boutique services business. So it's very challenging, right? And I just feel like there are too many companies which have entered because the entry barrier is very less. And everybody can come up with a model and promise that this will generate a great alpha or whatever IRRs and all that. The other space where there are a lot of companies in India is unsecured lending, which is all the loan apps that you see. Although it's a pretty bad characterization when you call them loan apps, because some of them are really doing a much better job and they're looking at many other things. But then 80% of them are just loan apps, right? So unsecured lending, there are too many companies, and there are bunch of problems associated with that, right? Because one of the studies said that young people who are actually taking loans from, let's say, one of these companies are over leveraged because they also have loans from these other companies as well. So some of these folks were found to have like 4 or 5 loans, small sizes, and then they were buying iPhones and things that they can't afford, which is very troublesome, right? So there's that problem, but also it is oversaturated because uh, I think people have just figured out that even with very high NPAs, there's a good way to actually go out and charge 30, 40, 50% IRRs, 50% interest rates. And even after the defaults, you will still make a good net interest margin. And therefore, a lot of people just enter into this because in this country, which is credit deprived and people need money, if you offer loans, people will take it. And therefore there's a natural product market fit. You don't even have to tie, like if you come up with a loan product and if you start offering, there will be people who will take it. So unfortunately or fortunately, there are lots of companies in that area. It is oversaturated.
Yeah, but what
um,
happens when they don't pay the loan? That can happen, right? That these people are
that
taking the loans, but
happens.
they, yeah. So what
Yeah,
happens
that
then?
happens a lot actually. That happens a lot. So what happens is, I'll describe it in two different ways. One from a fintech or a lending company perspective, whether it's a regulated entity like an NBFC or a bank, or it's unregulated and it's partnering with these NBFCs or banks. They have something called DPD 60, DPD 90, DPD 180. It means days past due. So as the loan is not paid and that time period starts maturing, they get worried, right? So they have different methods of collections. So they start following up more rigorously as we go towards the right side of the spectrum. Luckily now the government and the regulator and everybody has chipped in so that there are no unfair practices of collections. But I believe it's not like people still maybe using some of the methods. So just to answer your question, I think from a company's perspective that is what they do. But from an individual perspective, a lot of people don't realize this, but when they default on a loan, their credit score gets hit, and then in the future if they want to take home loan or any of these essential loans, they'll face a lot of problems. Now in this country it has not started, but in countries like US you can't even get a place on rent, because even for rental places they look at your credit score, and for so many other things. In China they have gone totally crazy with this. They call it a social score, so they take like hundreds of other parameters into account, and your social score goes down, that means you can't get like a Amex credit card or a like any of those many services which are provided by the government or private companies. So it can become a big problem if you're not paying back the loan.
Absolutely, totally agree. And just recently I've been seeing at least 4 to 5 notifications every day on my phone that you have this cash ready on my, some companies are directly calling it your cash is lying there and not even calling it a loan, right? So I think
Yeah,
it's
yeah,
getting into the misleading territory, which is actually
yeah.
bad. uh
Which is a problem, right? So that's what I was saying.
yeah,
There is over leverage problem, there is
right,
overselling involved, and all of that. By the way, just to finish, I think I did not
sure,
answer which segment is unsaturated, because
yeah,
that's
yeah,
kind
yeah,
of my favorite question. Thanks
absolutely,
for asking it. So I feel that in India, if you look at any of the big fintech companies, right, PhonePe, Paytm, look at any of those companies, a lot of them are distribution first companies. Like in general, in India, I have seen VCs and investors funding companies which are distribution led companies, right? So unlike a few of the other spaces, fintech has not seen a lot of deep tech companies. Like, people, a typical deep tech companies where you have spent 1 to 2 years on R&D and D and building the product because so hard, and solving a problem which has existed but it's very hard to solve, and you have spent a lot of engineering time on hardware or software or both, to come up with a solution for that. I think one classic example in the case of financial services or fintech is fraud detection and prevention. Fraud detection and prevention involves very, very complex algorithms and understanding, and it's also evolving because fraudsters are becoming very smart. They used to use rules based engines, then they went to machine learning, now they're using AI. And similarly, you have to also keep pace with that, right? So that is a space I think we have generally been lacking companies. I think there are countries which are known for that, like Israel and US and few other places. I think we need more in India because the fraud is rampant in India. Like, this is something that you would not typically see people talking about and media talking about. But I think, without going into the political side of this, or some of the regulatory, I feel nobody is incentivized. In fact, a lot of them are de-incentivized to not talk about fraud. But the fraud is rampant in this country. Like, there is account takeover fraud, there is UPI fraud, there's all sorts of frauds which are happening, and we need better solutions to curb, to bring fraud detection and prevention. But it takes time to develop these solutions. Also, earlier, the deep tech fintech ecosystem was not there to fund these companies, because you will be sitting investing in this company, but nothing will happen for like 2 years because they're still developing the solution. So it's painful for an investor, typical investor, to invest in these companies. But I'm very happy to see that the entire deep tech ecosystem is changing. There are now deep tech focused funds which are coming up. And an example from a non-financial services space is that earlier, if you were developing, let's say, a hybrid drone which could get powered by solar, and therefore it can fly for not just 2 hours, but it can fly for like 6 to 8 hours because it's solar powered. It's a hybrid drone, and therefore it has applications in defense and areas where you need the drone to be in the air for a longer time. Those kind of things were not possible to be funded before, but now they are getting funded. But they're also finding domestic markets. So these kind of companies are actually getting contracts from defense and government and private enterprises. So that is amazing, because once you start getting local investment as well as local demand, you can grow the company to a certain size and then take it international and sell it everywhere. So I think I'm hoping that the same thing will happen in some of these underpenetrated deep tech markets in financial services, like fraud detection prevention.
right, right. Absolutely, and you yourself is a fintech founder, exited fintech founder, and now you're investing in other founders, not just fintech but even B2B, right? So, how does your past operational experience for seeing so many companies, the data from so many companies, and also building one yourself as well, right? So, how does that experience help in helping your portfolio companies succeed and not make the common mistakes?
Yeah, I think one of the reasons I got into this was that I could help based on my experience of building a company, selling it, the M&A experience of managing a company which was headquartered in the US and had subsidiaries in three different continents or three different countries, like Singapore, Europe, in Italy, and then in India. So all of that actually comes very handy also, because we were selling to banks and FIs. So a lot of fintech companies also sell or partner with banks and financial institutions. So all of that experience actually is something that I've seen founders value. um, I also feel that so I have a joke that investing is like VCs are like management consultants with money, right? So they basically give the capital and then they give advice as well. It's up to the founders whether they want to take it or not. The capital everybody will take, but advice may or may not. There's also a lot of bad advice. Like I would say 60-70% of the advice in the market, like really bad, because people kind of give advice from a company in healthcare space that they saw and apply it to fintech. Sometimes it may not work, sometimes it does. And as I said, right, there are no rules, there are no patterns in the startup world. So if you're trying to apply something from somewhere to something in the fintech space, more often than not, it will bomb, right? So because of all those things, people want very specific sector focused, advice. And I think that's where we come in. And I feel that capital is just a part of it, but essentially, I also love that 0 to 1 journey, and like today itself in the afternoon, I spent like 2.5 hours with one of the portfolio companies, and we looked at the entire new product that they're building in and out, a lot of feedback, insights, things that could go wrong, how to look at the GTM and everything. So that is the part that I enjoy the most. And some of them also I've been able to help on the M&A side. So one of the companies, kind of got me involved in the entire M&A process from end to end, which I have done now a couple of times. So it just gets easier.
Absolutely, that's surely very helpful. And you briefly mentioned about selling to banks, right? I think that's a very important aspect of a lot of fintechs need to do that, right? So, can you give us an insight into how hard it is selling to banks? How many stakeholders are involved in that, and how long are the sales cycles on that front?
Yeah, selling to banks is hard, very hard. I think there are also mistakes that we do, right? So, for example, a typical 25-year-old engineer who has worked in a software company, like an international software company before, and starting a fintech company, one of the things I've seen going wrong is that they basically have a very supply side view of, like, now I have built a solution, I have a hammer, and everything looks like a nail, right? So the problem with that approach is you go to a bank, and yesterday only we were having this discussion. So with a banker who has seen now 2 or 3 different AI based underwriting solutions, how do you write a loan using AI? And he was like, how do I explain these guys, engineers who are pitching me these solutions, that my bank has like 70 different systems. So if I have to implement a new BRE or a business rules engine or an underwriting engine, I actually, that is one problem for me, right? To solve. The bigger problem is, how do I make sure that the system is able to talk to all the other 70 systems that I have? And how do I convince my IT and compliance and legal and all of that, that, we can actually have this underwriting be done by AI, which we may not be able to decipher? There are lots of problems like that. So I think there are problems on both the sides, right? People say that the banks are slow, but they are slow because of the way they are built, right? There's a lot of legacy software and all that is fine. Most of them are actually issues around like IT, legal, compliance, which is where this thing gets stuck. I don't think Indian banks are not progressive. Indian banks are very progressive. Indian banks are looking for, the next sort of, they always have a very good roadmap in terms of what we need to build next and where we need to go. You can see that with the way UPI has been implemented and, everybody is using in the country. But there is a way to sell. I think founders also need to learn that way of engaging with the banks, have the patience. It takes time. It does not happen in 4 days. This is not like building Uber or anything. This takes time. And I think also on the bank side, they have to internalize innovation. They have to make sure that the IT, legal, compliance, and everybody's aligned, that the product that they're selling, let's say an underwriting engine you're selling to the head of credit, they are not the customers of it, right? So legal department thinks that we are going to use it, IT department think that we are going to have a say in this. They should not, like, their role is only limited to a certain extent. I think the head of credit is the real customer of an underwriting solution. So this type of internalization of innovation has to happen on the bank side as well. Yeah, it continues to be hard. You need referrals. You need to enter with the right, like, recommendation. and then you need to have the right set of processes and patience, and for example, just like simple security audit, those kind of things, you need to have all of those things also in check.
Absolutely, totally agree that that's good insight there, and I think it's also very important to target the right person, because if you target the wrong person, there they can end up wasting lot of your time and not
True.
getting you anywhere, right? Awesome. And
Absolutely.
another thing that you have talked about on social media is that small IPOs, small SME IPOs should be an option that Indian founders should consider, because
Yeah.
some of the small SME IPOs that have been done in the US are now doing considerably well, right? So,
Yeah.
talk more about it.
So it was very interesting when I put out that post. It went viral, and I got a lot of reactions. A lot of founders reached out to me and said that this is incredible. We just didn't know about this option. I was actually amazed that the amount of people who did not know that there are multiple ways of building companies, right? So this is my favorite topic, right? So I'll go back to the thing that I said in the beginning, that at 77 Capital, we don't have any rules, right? So it is very counterintuitive when I'm talking about SME IPOs and an alternative journey, which is actually against the typical VC model, right? And I understand why some people did not like that post to some extent, but so here's the reality, right? That media and whatever you see on Twitter and a lot of things are all geared towards startups raising money. You see a lot of news. In fact, if you are a startup and if you write to any of these publishers that you have raised funds, they will immediately publish it. They won't even take money. They will. PR also does not have any problem. Those are the simplest pieces that you can get into the publishing. That is where the problem is, right? Because what people have started believing after reading all the media and all the Twitter and everything that goes on LinkedIn, that there's only one way of building companies. You start a company, and then you reach out to angels and micro VCs, and then you reach out to VCs, and you do your A, B, C, D, and all those alphabets, right? But you're highly mistaken if you believe that that's the only way of building companies. There are two other ways of building companies, and Prashant, you know this very well. You are also building in a different way, right? So what I had explained with SME IPO is, in India, there's an incredible opportunity to do exits and raise money and do whatever you want to do in a much more sustainable, profitable fashion. So here is the kind of the framework of how you can do it. You start a company. There's a problem that you are solving that's like very hygiene. You should have a delta 4 product if possible, but at least it should be 2x better experience than whatever exists before. If it is 4x 5x, even better. And then what you need to do is you need to start developing good habits from day zero. Okay, so what are bad habits? If you got $2 million investment in pre-seed, right, at a $10 million valuation with a deck, pre-money, pre-product, the bad habits that you pick up is you will go and take a 10-seater office in WeWork, right, or 20-seater office in WeWork, and then you will hire the most expensive sort of software. When you use cloud, you won't optimize it because you're not worried about that. You will pay people who are earning 25 lakhs 50 lakh salary, right, and hire them tomorrow because you can onboard them quickly if you offer them double the salary than what market is. All of these in my mind are sort of bad habits, not in every case, but in a lot of cases these are the examples of things that can go wrong, right? Now in a typical framework, that SME IPO that I'm explaining, you will be cautious, right? You will spend in the right things, but you will be cautious about not developing bad habits, and you will spend on the right things, right? So you'll optimize your cloud spend. You will basically probably work remotely in the beginning, and then maybe find a smaller office somewhere, right? You sort of bootstrap the whole thing. um, I feel that you should raise money once, let's say a couple of crores, so that you can hire the right people. You can also pay for AWS, office space, or whatever things which are required, and then basically try to be profitable within the first 15 to 18 months, right? So develop good habits around economics and what is the pricing of the product. If you're building something for $2 and selling it for $1, it if you are not making money today, I don't think in 4 years down the line also you will sort of change that habit, because you'll keep raising money and you will never have that view of the cost economics, right, unless it is forced down upon you. Why not develop good habits right from the beginning, like the businesses that our father and grandfathers used to do, right? They used to look at profitability as quickly as possible. So do that. 15, 18 months, you get profitable or at a smaller scale, totally understandable. Keep going. In the fourth year, as you enter, let's say you have hit like a 10 crore revenue, and let's say you have a 50 lakhs profit, right? Not asking too much, right? 50 lakhs of profit. You can then go and do an SME IPO on an NSE Emerge or whichever platform that you want to do. The advantages are multifold. One, you are able to raise money at that point of time, whatever requirement is there. Secondly, you become a public listed company. The trust level goes up. Like VFin is one of the fintech companies that listed, and then after 6 months they close a mega project with Yes Bank, because I'm guessing that the Yes Bank buyer would be thinking, okay, now I'm working with a public listed company, right? The trust level is next level. So you start getting more customers, you have more money, so you can spend on marketing, sales and all of that. um, you are structured in such a way that you are profitable yesterday and then you will be profitable in the future, so you can go and raise more money. It's a process called FPO, so you can keep raising money after doing SME IPO. And then one day you can actually take it to the main board, right? The place where all the big IPOs happen. So you can, the process actually becomes much simpler because you're already on NSE Emerge platform. They already know you, they already have your data, so you can go to the main board, raise tons of more money and keep growing, right? And see, public markets at 50%, 70%, 100% growth every year at a certain scale, they will reward you. They love that. No, there will be no VC who's telling you to grow 5x every year. And because when the ask is to grow 5x every year, and if you're not a product or a market where you can grow 5 7x every year, what you will end up doing is you will utilize that money to inorganically sort of acquire customers which may or may not be good. They're not the best quality customers. You will also underprice to penetrate the market, not a very good strategy sometimes, and so on and so forth. So my point was that there is an alternative way to grow companies, right? And SME IPOs also, this journey, the framework that I said, is only one of the ways. There are multiple ways in which you can grow companies.
Absolutely, totally agree. And for sure, I think VC backed startups has become the norm because it's so much popularized by the media. But I think there are so many different ways of building businesses, and there are different types of businesses that suit different people, right? So the reason why I chose to build my businesses without any VC money and all are cash flowing businesses is because I'm not the kind of person who can handle that pressure of building a VC backed business, because that's immense pressure that's put on you to rapidly scale, right? So I want to build a business that I can grow at my own pace and also have money right out of the gate, right? So I think
Yeah,
different personalities also depend on what kind of business you should build. Not everyone should be building a startup at the first place, right?
right. Can I can I
VC
just
wise, yeah,
can I
sure,
just
sure.
add like one or two more examples? So I
Hmm.
met the CEO of Perfios, Sabyasachi, and I think he has said this in public forum otherwise also. But I asked him like, what is that one thing you will ascribe to your success, and something which has stood the test of time and all. And he said the same thing which I've heard from five other entrepreneurs, is that one very simple thing, which is, he said, look, when we started building, we were very focused on the customer and the problem and the solution, and we wanted to build it in a organic, slow fashion, so that we are building a profitable, sustainable company. And we kept doing it. We never raised money from VCs. And there were a few angels and all that, but we never raised, and we kept building, and then our product got very good, and then basically we became a much larger company, profitable, and therefore basically private equity players and others invested recently. So they compounded for so many years, and then just in the last 2 years, for example, India's largest traditional private equity firm, Kedara, which had never invested in a tech sector before, put a huge amount, $229 million in Perfios. That was, I believe, that is like one of the most iconic moments in India fintech, when a traditional private equity firm invested in the fintech sector for the first time, showing the resilience and the stability of the company and the sector. That is something to think about, right? That you can build a company in this way as well. Like there's no one way. Don't get carried away that you have to kind of raise money on day zero and keep raising.
Totally, totally agree on that. I think that there's some sort of a treadmill that goes on. Okay, I've raised pre-seed. Now in 6 months, I need to go to seed, and then 6 months or 12 months, Series A, Series B, and that has to keep
Yeah,
going. But one another way is that you another way is to bootstrap, of course, that's one. Another way to that is that you raise just one single chunk of money that you can use to, solidify your product market fit and get to organic scale, a system for scale that can keep scaling from there. I think
Yeah,
those
yeah.
two systems
And
need a lot more
profitability is
popularity.
beautiful, man. Like the last company
Totally.
we invested in, it's called MyLaPay. At a very small scale, they're already profitable. Once you have that, it is like such a power. It's the state of mind is different when you are profitable at a smaller scale, and then you can keep growing, right? I'll give you the a very example which describes the negativity and the toxicity of the whole sort of this, the race, the treadmill that you explained, right? Um, there was an early stage company which came to us for investment, and we were evaluating. We evaluate like 25 companies in a month, 20 25 companies. It's actually getting lesser because the number of companies is coming down. But we were looking at this company, and he said something very interesting. I asked him like, how much are you charging the customers for this? And that guy said that we are charging $99 for the whole organization. And I was like, boss, this is like a enterprise solution, and this will be actually priced like 10 or 20 times what you're charging, or perhaps even more. Why are you doing this? And he explained, sir, we are like a pre-seed company. We are looking to raise investments, and we spoke to some of the VCs, and they said, you are a little early. Come to us when you have some paid customers. So his entire way that he was working is, okay, let's work backwards. I have to raise money. My milestones in life are not about building a business profitably. My milestones are actually raising the first round and second round. So let's say I have to raise this round. What I have to do, I have to get paid customers. What is the easiest way of getting paid customers? Offer something which is $10,000 and $99, so I can get some paid customers, and I can show to the VCs that I am, now I have paid customers. Please put money, please invest in. See, such a wrong way of kind of thinking about. And look, I want to say it very humbly that we have all mistakes while building companies, and we will continue making. None of this I am saying like is 100% true. I'm saying a lot of this is my opinion, but I feel like this is exactly the kind of wrong thinking that is hurting a lot of startups.
Yes, I totally agree with that. And that is also probably the reason we are seeing a lot of down rounds happening these days, and massive slashes in valuations of the biggest startups. Probably they built it the wrong way, and their growth was actually dependent so much on the fundraising aspect and not so much on the internal systems they built. And
Yeah.
and one interesting incident that has happened recently is the Paytm Payments Bank incident that has kind of shaken up the fintech landscape entirely when that happened, right? Uh, do you think that is going to have any long term implications on the fintech landscape in India?
Look, I think the Paytm saga, although we will never know what happened, internally in the organization, obviously there was a regulatory clampdown because the compliance was not up to the mark. Mm, One of the news reports said that on one PAN card there were like 1,000 customers. So we will not know, right? We will not know the entire story. And I would also say that this is not the only case. I think this happens in other organizations also. But one thing to remember in fintech is compliance is not an afterthought. It is like front and center of everything you do because you are managing people's money. It's financial technology after all, right? So I have I fail to see a serious thought about regulations and compliance in many of the fintech companies, um, and now it's changing. It's changing because the regulator is coming down hard, and you know there's a clampdown on various business models. I think what happened with Paytm, is going to have the effect on the market, obviously, because a lot of money which is put into the startups in India in fintech space or otherwise is actually sort of American dollars, or there's a guy in Canada who is a teacher, and his money actually goes into Indian startups. You know how, right? Like there is Canadian pension fund, teachers pension fund, and they will put money into some of these VC firms, and VC firm will put money. So there's a lot of global investors who are investing in India and looking at India as a great powerhouse of technology and innovation and all of that. All these issues which are happening, like in some of the other companies we have seen, so many governance issues and all of that, right? Without naming them, all of this is going to hurt India Inc.'s image. And I think somewhere, anyways, there is a tech meltdown, so there's the things are getting a little harder. So raising money, growing companies, getting international investors, all of that, I think gets affected by each of these incidents which happens. The only positive side is that now people have started taking compliance very, very seriously. And I think in the next few years, we will see a lot of demand for compliance officers, and making sure that you're not building in regulatory gray area. Like Prashant, I'll tell you, like 10 years back, fintech companies used to think about what is the regulatory arbitrage, like what is the gray area in which we can actually build a solution because the regulation is not clear. Today nobody does that.
Absolutely. I think that that's been a case for startups across the world. A lot of popular startups have leveraged that regulatory arbitrage. I think Uber was one example, wasn't legal in the first place, but then worked their way out. But I think the Indian government has made it very clear that there is no arbitrage here, and you have to follow the rules, right? Awesome. With that, we come to the end of this conversation. So I'll do a quick rapid fire round wherein I'll
Yeah.
ask you five quick questions about the investing you're doing at 77 Capital, and you have to give five quick answers, right?
Okay.
So the first one is, what are the sectors and regions you invest in?
We invest in fintech, especially B2B fintech, B2B software, AI, Gen AI companies, and one of other interesting companies, etc. And the regions are typically India. Most of it is actually India incorporated companies, but we sometimes do companies which are actually US incorporated or Singapore incorporated. But also run by Indians, because that's the demographic of founders that we understand the most, we connect the most. And obviously there are some exceptions. I've invested in companies outside of this, whatever I described, but those are typically really exceptions.
Right, right. What's the typical stage of investment?
In the past we have done pre-seed and seed, but more and more we are kind of graduating. So we may be doing more of seed to series A.
Awesome. And what's the typical check size you put in?
We have been putting check sizes of, let's say, around 50 to $100,000 in the past. Again, we are graduating and we will be putting much larger checks, ranging from 1 crore to, let's say, 2 or 3 cr as well in some cases.
Awesome. And you lead rounds, right?
We don't lead rounds, but what happens is that most of the people who invest in the fintech space, I know them very well, including
Right.
micro funds, large funds, international funds, which are very fintech focused. So I have actually created rounds where basically I brought in two of the friendly funds and three of us basically invested together. So that is very common, but we don't lead the round because for
Okay.
leading a round, you need a slightly bigger check size, and also you need the entire machinery for doing due diligence and all of that.
Absolutely, totally. And where can founders apply for funding in case there's a direct way?
So we have a website called 77 Capital. On that, they can actually, there's an email ID mentioned, so they can email, and obviously they can reach out to me directly as well on LinkedIn, Twitter, or my email ID, which is Amit at 77 Capital.
Awesome. And last one is, where can our listeners follow you?
I'm actually decently active on LinkedIn and Twitter. Actually, let me rephrase that. I used to be very active on LinkedIn and Twitter, and have a bunch of followers there. But lately, I have been a little slow. But I still engage there pretty much. So I'm on Twitter. I'm at Twitter, and then I'm on LinkedIn. Easy to find.
Absolutely. I'll make sure to put all those links in the show notes below so that our listeners can find it easily. Thanks so much
Okay.
for making time for this, Amit. It's been an incredible, insightful episode, and I look forward to putting this out. Thank you.
Yeah, Prashant, thank you so much for doing this and inviting me. And I think these questions that you asked were pretty spot on. Really like the questions, very thought through, researched questions. So, I think I always say that the hard work shows up in the output.
Thank you. That really kind words, and I really appreciate it. Thank you so much.
Thank you. Bye bye.